Financial wealth. Financial wealth is money and investments that hold value without needing a physical form. We're talking about cash, bank deposits, stocks, bonds, mutual funds, pensions, cryptocurrencies, and other financial instruments. The value comes from what these assets can be redeemed for or the income they can generate. What makes financial wealth distinct is its liquidity and divisibility. You can convert most of it to cash relatively quickly, and you can hold it in precise units like dollars or shares. You own some assets outright, like the money in your savings account or the equity shares you purchased. Other assets are owed to you, like bonds where someone else owes you repayment with interest. Financial assets typically earn returns. Hold stock, and you're entitled to a share of that company's profits through dividends. Put money in a savings account, and it earns interest. The potential for capital gains exists too. Buy an asset at one price, sell it at a higher price, and you've made money. Markets and economic policy heavily influence this type of wealth. Interest rates go up and bond prices fall. Inflation rises and your cash loses purchasing power. In the United States, as of 2025, about 37% of household wealth sits in stocks and other financial instruments, according to the UBS Global Wealth Report. The advantages include liquidity and potentially high returns over time through compound interest or market appreciation. You can diversify across different types of investments to manage risk. Many come with insurance or guarantees, but there's a flip side. Market prices swing sharply during economic uncertainty. Inflation erodes cash holdings. If you're earning 2% interest, but inflation runs at 5%, you're losing purchasing power. Banks can fail, companies can go bankrupt, and your investment might vanish with them. Physical or real asset wealth. Real asset wealth consists of physical property and goods that have intrinsic value from their utility or scarcity. This includes land, real estate like homes and commercial buildings, infrastructure such as farms and factories, natural resources like gold and timber, and collectibles including art and jewelry. These assets tend to be illiquid. You can't sell a house as quickly as you can sell a stock. They provide direct utility. Land can be farmed or rented. A house provides shelter. Machinery enables production. Real assets usually hedge against inflation because their replacement cost rises with prices. The advantages include stability and intrinsic utility. Real assets often hold value over the long term and can produce income through rent or productive output. You can sometimes leverage them by borrowing against their value. The disadvantages are substantial. High upfront costs make entry difficult. Ongoing expenses like maintenance and property taxes add up. Real assets are geographically concentrated, exposing owners to local risks like market downturns or natural disasters. A housing market crash can severely reduce property wealth. Intellectual and creative wealth. Intellectual wealth is the stock of knowledge, ideas, and creativity that can generate value. It includes patents, trademarks, copyrights, trade secrets, design rights, brand value, and the specialized know-how within organizations or individuals. Unlike physical assets, intellectual wealth is intangible but protected by laws. This wealth is non-rivalrous and scalable. One item of intellectual property can be used by many people at once without depletion. Software licenses can be sold to millions of customers simultaneously. It typically requires some legal system for protection to be monetized. Examples include patents on pharmaceutical drugs that allow companies to charge premium prices for years. The Coca-Cola secret formula is a trade secret worth billions. Well-known brands like Apple's logo and designs command customer loyalty and pricing power. The advantages are compelling. A single idea can create value repeatedly at low marginal cost. Strong intellectual capital leads to higher profits and market entry barriers for competitors. The disadvantages center on protection and valuation. Theft and infringement are constant risks. Estimating the worth of intangible knowledge is complex. Intellectual assets can become worthless if technology or tastes change. Human capital. Human capital is the accumulated value of people's skills, knowledge, health, and abilities. It's the economic value of a worker's attributes that can produce earnings or productivity. Human capital is an intangible asset embodied in people, not directly listed on financial statements. Human capital increases through investment in education, training, and healthcare. A more educated or healthier workforce is more productive. It tends to accumulate over a lifetime as a worker gains experience and can depreciate if skills are not used. McKinsey notes that human capital represents 2/3 of an individual's wealth on average today. The advantages of human capital underpins economic growth and innovation. Well-educated workers command higher wages and can adapt to new technologies. Societies benefit as healthier, educated populations often have lower crime rates. The challenges include uneven access due to inequalities in education. Human capital can migrate through brain drain, where skilled workers leave poorer regions for richer ones. It can become obsolete if technology or industries change rapidly. Investing in human capital takes time and resources, with payoffs that may be long-term. Social capital. Social capital refers to the value arising from social networks, relationships, and norms of trust and reciprocity. It's the wealth that comes from healthy communities and connections. The more trust and connections people have, the easier information and favors flow among them. Social capital is collective rather than individual. Key aspects include networks like family ties, friend groups, and business associations. Strong social capital can improve efficiency because people help each other without transaction costs. Examples include business networks that lead to job referrals. Many people find jobs through personal connections rather than formal applications. Community organizations support members during hardships. Family networks provide startup capital or advice to entrepreneurs. Online platforms like LinkedIn are modern vehicles for social capital. The advantages are enhanced cooperation, information sharing, and mutual support. It leads to job opportunities through referrals or low-cost credit among trusted friends. Communities with high social capital often have lower crime rates and better outcomes in health and education. The disadvantages are the potential exclusivity and nepotism. Tight networks may favor insiders and exclude outsiders, undermining meritocracy. High social capital in one group might coexist with low overall social capital if it fosters corruption or group conflict. Natural and environmental wealth. Natural wealth encompasses a country or region's stock of natural resources and ecosystems. Water, air, minerals, forests, biodiversity, and land all fall under this category. It includes both extractable resources like oil and metals, and ecosystem services like water purification by wetlands and pollination by insects. Natural capital can be renewable or non-renewable. Forests, fisheries, and solar energy renew themselves under proper management. Oil and minerals do not. It provides raw materials and services. Crop soils support agriculture. Clean air supports health. Examples include a nation's oil and gas reserves, which generate massive export revenues for countries like Saudi Arabia. The advantages are fundamental. Natural wealth provides the basic inputs for economies through energy, raw materials, and agriculture. It supplies life support through clean water and air. Countries rich in natural resources can gain wealth through exports. The disadvantages include the risk of depletion and environmental harm. Over-extraction can destroy the resource base. Deforestation eliminates future timber harvests. Economies dependent on natural resources can suffer the resource curse, experiencing volatility and neglecting other economic sectors. Climate change threatens natural capital stocks globally. Cultural wealth. Cultural wealth is the accumulation of a society's traditions, values, knowledge systems, art, language, and customs. It includes everything from shared history and art to everyday cultural norms that give communities identity and cohesion. Pierre Bourdieu described cultural capital as familiarity with a society's legitimate culture, acquired through family and education. Cultural wealth is non-material and collective. It shapes people's worldviews and behaviors. It includes formal cultural artifacts like books, art collections, and monuments. It also includes embodied elements like language fluency and etiquette. Cultural wealth is passed through education and upbringing, and often translates into social advantage. Traditional art forms preserve cultural practices across generations. On a personal level, being raised in a family that values education or the arts imparts cultural capital. A country's cultural industries, through film and music, reflect cultural wealth. The advantages include fostering social cohesion and shared identity. Research shows that cultural capital in families helps children succeed academically and access high-paying roles later. It promotes tourism and national pride. Italy's cultural heritage attracts millions of visitors annually. The disadvantages are that it's hard to quantify and often unrecognized in economic terms. Cultural capital can create inequality. Those lacking the right cultural background may be disadvantaged in education or job markets. Globalization can dilute cultural wealth, replacing local traditions with homogenized global culture. Digital and data wealth. Digital wealth includes assets that exist primarily in digital form. This encompasses cryptocurrency, digital tokens, data, software, online accounts, domain names, and digital media like videos and music. With the rise of the internet and blockchain technology, digital forms of wealth have become a significant new category. Digital assets are non-physical, but can be owned, traded, and stored electronically. Key traits include global accessibility. You can access them anywhere with internet, but vulnerability to cybersecurity risks is real. Digital wealth is easily transferable through instant global transactions, but also prone to high volatility. Data itself has emerged as a valuable resource for businesses. Some call data the new oil of the digital economy. Unlike traditional assets, digital assets can be copied cheaply, except unique tokens like NFTs, which use blockchain to ensure uniqueness. Prime examples are cryptocurrencies like Bitcoin and Ethereum. Non-fungible tokens represent unique digital art or collectibles. Domain names like google.com are worth millions. Big data sets owned by companies, including customer data and analytics, are also assets. Even online game items have real economic value. The advantages include enabling fast, low-cost transactions and new forms of investment. Cryptocurrencies offer decentralized money outside traditional banking systems. Digital assets are scalable. A piece of software can be replicated infinitely at near zero cost. The disadvantages are significant. Digital assets are often highly volatile and speculative. Crypto bubbles have wiped out billions in value overnight. They require technology infrastructure and are vulnerable to hacking, fraud, or data loss. Regulation is still catching up, creating legal uncertainty. Digital wealth can exacerbate inequality if access to technology is uneven.